Alright, these three spreads can be used in two different ways. Either as a pin, which means you're predicting the exact price you think the stock will be at expiration, or the opposite, that the stock won't be even close to the strike price at expiration. Let's look at the straddle first. This is like a strangle in a sense that you sell a naked call and sell a naked put. The difference is you do this at the same strike price. This gives you some of the best theta of any spread, but gives you unlimited loss potential. This is a harder spread to tell exactly where you will start to go negative because you don't have the parameters like the strangle. On a straddle, the P&L analysis looks more like a spike or a triangle rather than a plateau like a strangle. On a straddle, you make max profit if the stock lands exactly on the strike price of your straddle at expiration. You do have some wiggle room because of IV. You will be profitable if the stock is just somewhat close to the strike price. You just don't want to overshoot the stock or undershoot the stock by a lot. You need it to be somewhat close. Because this is an unlimited loss type of trade, it does take a lot more buying power. But that's why there is a different option called the iron fly. The iron fly is the exact same thing as the straddle and works the same way, except you define your risk by buying a put on the bottom side and buying a call on the top side. You might recognize this pattern. This is because it is the same as an iron condor. Just instead of having different strike prices between those two short options, you put them on the same strike price. This really is just an iron condor with a triangle-like P&L analysis, rather than the plateau type of look on an iron condor. There is another way to look at both of these. That is, doing these as debit spreads, rather than credit spreads. So you buy the call and the put at the same strike price. This creates the exact opposite situation. A trader would do this if they are predicting a large move and an increasing IV, but they don't know which direction the stock is going to go. As you see, the P&L curve is just the exact opposite. Your trade will be positive the further the price gets from your debit spread. You might think it's a perfect spread for earnings, but in reality, it's really not, because the IV is likely very high before earnings. And doing this type of debit spread will have a very large negative theta. The same thing is true for the iron fly. Most traders do not do the debit spreads with strangles, iron condors, iron flies, or straddles, as the odds are very against them with the high negative theta. Lastly is the butterfly. This is a lot like an iron fly. You have two calls or puts that you sell at the strike price that you believe is going to be where the stock will be at expiration. You then buy a call or put above and a call or put below those middle two contracts. It looks something like this. As you see, it has the same P&L analysis shape of the triangle. You will also see you will usually get amazing risk-reward ratios. That is because the likelihood of it happening are not very high. However, if you are confident in a setup, a butterfly could be the best risk-reward ratio trade you can put on. Something to note is it doesn't really matter if you use puts or calls, as long as all of them are the same. You can do a few variations of this spread. You can move the wings out to change your P&L curve to be more of a bullish or bearish butterfly. You can also change up the ratio of the spread. In the normal butterfly, you buy one wing lower, sell two contracts in the middle, and buy one wing on top. In this ratio, if you wanted two butterflies, you would have two on the lower, four in the middle, and two on top. But you can change this ratio and turn this into an unbalanced butterfly to something like one lower, three contracts in the middle, and two contracts up top. This does the same kind of thing, making the butterfly either more bullish or more bearish. I hope you can see after going through all of these spreads, they are very much related. Some give you better risk rewards, and some give you better chances of profiting. It is up to you on which ones to apply during what kind of market and what kind of setup that you have. The most important thing to remember is know your risk on each trade and know if the IV is in your advantage. Large IV typically means to do a credit spread, and a low IV typically means do a debit spread. Recognize if collecting the credit with a credit spread is better, or banking that the IV will increase with the debit spread. There are a few other spreads, like a calendar, that is essentially a vertical spread with different expiration dates, or a jade lizard, which is like an iron condor mixed with a strangle, having one side as a vertical spread and the other side as a naked option. You can play around with other spreads, but all that I have mentioned are the most popular, and I hope it can help you see and understand how they work. And I'll see you in the next video.